Brian Szytel is with us, co-CIO of the Bahnsen Group. Brian, thanks for your time. What should the second quarter playbook look like, given the environment that we are in?
Well, I think for us, it's a focus on income. So a bigger driver of total return will come in the form of income. We're dividend growth investors, and so that's where we tend to play. But I think if you position yourself a little bit more defensively in some of those sectors like financials, energy, staples, you have the ability to capture income over the next quarter and let this tariff talk settle itself out.
So in other words, Brian, we should look for an opportunity to re-engage US markets once Doge and this tariff impact is behind us. So do you think that tax cuts will replace this very challenging tariff narrative in the second half of the year? And is that when we load up on financials and banks?
Well, I think you can own those already. I would be going into this period of time. Remember, this year, what has pulled back here has been consumer discretionary and technology mainly. There's a small pullback in industrials and materials, but healthcare, staples, energy, financials, all these sectors are significantly positive on the year. So you can own them now. But as far as going into the tax reform, I think if we get towards third quarter of 2025 and there hasn't been something that has gone through Congress, then I think that would be bad for markets. I think markets have not priced in an extension or a permanent extension of the tax cuts from the first policy from Trump 1.0. And I think if you have some tariff uncertainty along without tax cuts that get passed, then I think markets would be unfriendly to that. That's not my base case, though. I do think they'll get something done sometime around summer.
Brian, talking of what's priced in and what's not, it seems that leading into April the 2nd, it's been a by and large sell the news event, and yet come April 2nd, i.e. tomorrow our time, might it be a buy the news?
Well, good point. I wish I could tell you what is being negotiated now and what will ultimately be negotiated from now until then, even though it's just a day or two away. I don't think the market knows, and I think that's why you had the lows breached earlier this morning and then a big recovery here up 400 plus points on the Dow. And, markets are trying to digest something that is frankly undigestible. We don't know exactly what tariff rates will come down the pike. I can tell you that what is currently priced in is about a 0.5 percentage point of GDP, which is $150 billion. If everything gets completed the way that it has been proposed, it'll be a doubling of that. So call it 1% of GDP. So as far as your comment on buy the rumor or the news, I think it's tough to do either of those things when the administration itself doesn't know exactly where tariffs will ultimately lie. Neither can markets at this point. That's why I think being more income focused and defensive is important.
Yeah, it's the uncertainty that kills the market, isn't it? And to that point, it also feels like the market isn't convinced that there's a Trump put anymore. In other words, it does seem that there is a degree of short-term market and economic pain that the Trump administration is willing to bear in order to achieve its long-term goals. But do you think, Brian, that there will be a limit, whether it's a further market correction, whether it's stagflation, whether it's even a recession?
I think there is definitely a limit. And look, we figured out that it wasn't 10% because we just had a 10% correction and there hasn't been, a bluff or anything yet. If we got to 20, that's not my call. That's not where I think we are going. Do I think they'd change policy? I do. Do I think when you say something like, well, I'll change the tariff rate on China if there's a TikTok deal, if that shows you a level of commitment for what they're trying to get after, which meaning that it's low, I think this is about getting a deal done that's better than what we have now on global trade. And I think it's about bringing or attempting to bring manufacturing jobs back to the United States. But I don't think that they'll be able to stomach some sort of actual bear market in the process without changing tune a little bit.
Brian, what then are the odds of some flexibility, some leniency, carve-outs, exceptions? The president has said TikTok is not tied to a larger tariff deal, but could be. Is that going to take the sting out of reciprocal tariffs and Liberation Day, or is this going to herald the beginning of an all-out global trade war?
I don't think the latter. So my base case is not a global entrenched trade war, what we saw 100 years ago. Here, this is a different animal now. The world is more interconnected than it ever has been before. Doesn't operate in a vacuum. We're all tethered together here. But if you look at total tariff rates, the average tariff rate in the United States is roughly 2.8%. The average tariff rate in Japan and the EU is lower than that. It's around 2%. So my point is, this is a negotiation tactic around certain industries and interests in sectors. And I believe that, again, the design of this is to change consumer behavior. If goods and services are costing more from non-American made goods and services provided, then perhaps that changes consumer behavior. Perhaps that brings jobs back to the United States. But, you know, that doesn't have, that's not without its negative repercussions either. So all that to say, I believe that you'll get a version of what's been proposed, but it won't be the largest concern over what will sting and hurt the economy the most. I think you'll get a reasonable amount, call it 0.5 point to 0.75 point off GDP in this thing. You'll have an offset on some of the tax reform that they'll get through Congress, and then we'll move on.
Brian Szytel, thank you so much for joining us today. Really great start to the show.